It's 11:14 on a Sunday night, and, well, you're lying in bed doing the math again. Not because anything went wrong. Honestly, nothing went wrong. You're just lying there in the dark, running the exact same numbers you ran last Sunday and the Sunday before that. Welcome to this explainer where we're going to look at the exact math that's keeping you awake.
You know the drill, right? Mortgage, car payment, student loan, groceries. You're just trying to figure out if this is the month you finally get ahead, or if we're just going to tread water again like we have been for, the past 3 years? You know the answer, but you keep running the math anyway because the alternative is accepting that this is just what life feels like now. Meanwhile, your neighbor, the guy living on the exact same street who bought his house around the same time making a similar income, he woke up last Tuesday and just decided to take the week off. No crisis, no frantic email to the manager, and the crazy thing is, he isn't richer than you. He's just not doing that Sunday night math anymore. Today, we're exploring what the personal finance world wildly underexplains. What actually happens to your money, your career, your brain, and your entire life the literal moment you stop carrying the weight of a mortgage.
Okay, let's dive into this and start with the numbers, because the math here is honestly more brutal than most people realize. The average monthly mortgage payment in 2025 hit $2,329. And guys, that is just principal and interest. For someone who bought or refinanced at current rates, a payment of $2,845 is way closer to reality. Meanwhile, the median American household takes home roughly $5,400 a month after taxes, Social Security, and Medicare.
Which brings us to this harsh reality. On a median income, a standard mortgage payment is consuming 43% of your disposable income before you have bought a single grocery or made a single car payment. 43%. The absolute threshold that every financial professional on earth agrees on is 28%. So most people with a mortgage are walking around 15 percentage points over the limit every single month for 30 years. Congratulations. You are technically a functioning adult who has also agreed to be financially strangled in slow motion until you are 63.
Let's look at what that actually looks like in practice. Meet the Garcias. They're a dual-income household making a combined $110,000 a year. Now that sounds pretty solid until you run it through what life actually costs. After taxes and a modest 401k contribution, they take home about $6,800 a month. Now, let's watch it disappear. Mortgage on their $380,000 house, $2,400. Property taxes, insurance, and a maintenance reserve, that's another $900 just to legally occupy the building. 2 car payments, insurance, and gas, $1,320. Student loans and health insurance premiums, $930. Groceries and utilities, $1,120.
That leaves them with exactly $130. And we haven't touched clothing, kids' activities, the urgent care copay, the dog limping, or, any concept of actual fun. The Garcias aren't irresponsible. They don't own a boat. They are 2 professional adults who did exactly what society told them to do. Yet every single financial decision they make, every career conversation, every fleeting thought about going back to school or starting a side business gets filtered through one silent, defining question. Can we still cover the mortgage?
That question is running in the background of their lives like a tab you can never quite close. It's this low-frequency hum that dictates the entire boundaries of their existence. But that tab disappears the day the mortgage is paid off. And when it does, something the Garcias can barely even imagine right now happens. They start making completely different decisions.
So, what actually happens when the bank is finally out of your life? People consistently get this wrong in both directions. Either they completely underestimate the impact, or they wildly overestimate the actual cash they're going to have in their pockets. Now, what's really interesting about this slide is how it breaks down the reality of what really frees up when that mortgage vanishes.
You see, when that mortgage payment disappears, you do not suddenly have the full amount to invest. You might think you're getting $2,845 back, but property taxes, homeowners insurance, and maintenance, those still exist. In fact, for a $400,000 home, you are looking at roughly $838 a month in ongoing costs with absolutely no mortgage at all. So you aren't freeing up $2,845, you're freeing up around $2,000 a month in real deployable money. But make no mistake, that $2,000 is still absolutely life-changing.
Just look at what happens if you take that $2,000 and put it into a basic S&P 500 index fund, earning the historical average of 8% annually. In 5 years, you have $146,000. In 10 years, $365,000. And in 20 years, $1,177,000. You only contributed $480,000 of your own money over those 2 decades. The market contributed $697,000 on top of that. The vast majority of your eventual wealth comes from compound interest doing the heavy lifting, not from you working harder.
And you can bet the banks aren't going to tell you that their product is keeping you from $1 million.
But okay, I know what some of you were thinking. If your mortgage rate is below 4.5% or 5%, aren't you mathematically better off investing the extra money than paying off the house early? I get it, the spreadsheet logic is clean. A historical 8% return from the market beats a guaranteed 3% or 4% return from paying down debt. But here is the behavioral reality the spreadsheet doesn't know about. It assumes you actually invest the difference. Most people don't. They absorb it into lifestyle creep within 18 months. The spreadsheet also assumes you have the psychological fortitude to watch your investment portfolio drop 40% in a market crash while you still owe $2,500 a month in mandatory housing payments. Good luck with that.
But the spreadsheet crowd misses something even deeper, and that is the actual science of debt. According to peer-reviewed research, debt impairs cognitive functioning in measurable ways. You have literally been making the should I pay off the mortgage or invest decision from a cognitively compromised state. Northwestern researchers actually found that carrying high debt-to-asset ratios correlates with measurably higher blood pressure, higher rates of depression, and worse self-reported health. The brain doesn't just care about the dollar amount, it cares about the open tab.
So, the absolutely crucial point here is this stunning finding from a 2019 study in the Proceedings of the National Academy of Sciences. They tracked what happened when people's debts were fully eliminated, not just reduced but closed completely. The result? A massive 25 percentage point reduction in diagnosable anxiety. People didn't just feel better, they actually performed better on cognitive assessments and became measurably less impulsive.
I really want you to absorb this quote derived from the research. The mortgage is not just a financial obligation, it is a physiological one. Your body has been carrying it. This isn't a metaphor. When the mortgage is gone, your body notices. It's literally like the refrigerator you had stopped hearing finally goes quiet. And when that noise stops, your entire survival equation shifts. In the FIRE community, financial independence, retire early. The rule of thumb is you need 25 times your annual expenses to be financially independent. Well, if you eliminate a $2,000 monthly mortgage payment, that's $24,000 a year in mandatory costs, which means you reduce your financial independence number by $600,000. You haven't earned a single dollar more or gotten a promotion. You have simply changed what survival costs. Every dollar trapped in a mandatory monthly payment is a dollar that literally cannot absorb risk elsewhere.
And this brilliantly illustrates why understanding this is so urgent. Back in 1989, only 3% of homeowners over the age of 80 still had a mortgage. Today, nearly a third do. The share of 65 to 79-year-olds still carrying mortgages has absolutely skyrocketed, from 24% to 41%. We are dragging housing debt into retirement at a scale that has never happened before in American history, and we're just walking around acting like it's completely normal. Guys, it is not normal, and it is entirely avoidable.
So how do we escape? The math on getting there early is incredibly compelling. If you have a $450,000 mortgage at 6.5%, you're going to pay more interest over 30 years than the house initially cost. But look at these actionable steps. Switching to biweekly payments gives you 13 payments a year instead of 12. That simple move alone cuts 5 to 6 years off the loan and saves you $119,000 in interest. Throwing an extra $500 a month in principal shortens the timeline by 8 years, an extra $1,000 a month. That nearly halves a 30-year loan to just 17 years. These are not heroic sacrifices we're talking about here, but they are absolutely the difference between living free at 55 versus waiting until 63.
Now, I want you to imagine that finish line. The day the last payment processes. Only 23% of all Americans are completely debt-free. It is so rare that when people cross that line, they consistently report a profound silence they didn't even know was missing. But you need to know exactly what to do when that day comes so you don't waste all that incredible momentum.
So here is your exact playbook for day one of freedom. First, verify your lender filed the lien release and get your deed. I know, it's tedious, but lenders sometimes forget, and you need to legally own what you paid for. Second, rebuild your emergency fund. You've been house poor for a while, you need 6 to 12 months of liquid savings based on your new, much lower expenses. Third, deploy that old mortgage payment. Max out your 401k match, max out your Roth IRA, and pour the rest into low-cost index funds. If you do this with that $2,000 a month, you hit that $1.17 million in 20 years just by getting the bank out of your way.
I want to leave you with this final thought. The mortgage wasn't just a large bill. It was a permission slip you had to silently ask for every single time you wanted to do something different with your life. Want to leave a job you hate? Want to start a business? Want to take a pay cut to do work that actually matters to you? You couldn't, because of the mortgage. It is the invisible hand shaping all your major decisions. But when it's gone, the grip releases.
You stop running the Sunday night math, not because you're suddenly wealthy, but because you finally have the freedom to decide what you actually want. And that return of choice is worth running toward on purpose. So, what is your Sunday night math telling you to do tomorrow?